we're going to talk through what we do here, and the way we help people, and take a little more time to understand the different um, ways of looking at this career and actually enrich our offer to the public, to people, to everyone, but also to our prospects. We may have prospects here, we may have new people that are joining us tonight, I'm not sure, but if you're here or if you're looking at this, sometime later than today, then at least you can give us a reach of what do we dare to do. So in all things, we usually have to start by defining the problem because we're doctors. I like the way someone put it back in one of the conventions we were at. I don't know if it was last year or a couple of years ago. Someone said that we are doctors, just like we have medical doctors, we are financial doctors. And we, as doctors in any profession, we just have to first understand the problem or do a diagnosis to patients or clients in that case. So what we do really is what's on the screen there. We first have to look at what are the threats, and then we present solutions. And if we are effective in addressing those problems out there, providing the right solutions, then that one sets us not just in the right profession, but also up for a better experience with what we do and being effective in the lives of our customers, our prospects, or actually, if anything, everyone out there, because we believe for sure that this financial matter applies to almost everyone out there. So the problems and then the solutions. What are some of the problems that we dare to address? The first one here, as we can see, is death. Our field, what we offer, our products that we offer have a lot more to do with this. And this is a common threat. It's a threat to, the rich, the poor, the educated or none, the whoever, young, old. Death is very usually devastating and leaves the loved ones, the families, and actually many other people behind in a pretty crazy situation if one didn't really anticipate it. And then comes sickness, which is the second piece. And this one equally applies to everyone because, who knows when it comes around. Life can, be very interesting, and it gets even more worse when such things of sickness kicks in or disabilities. You're not dead, but then you're not living either. The third piece is retirement. Uh, I called it Izauku. That's the Kenya Rwanda. I hope there's no one there that is thrown off by those two words. Izabukuru, or when you're no longer working, which we call utajikora. But then just put this one together and then kind of go through one language and find myself swinging on the other one. But this third piece here is all about when you're no longer working, when you're retired, basically when you live long. I mean, longevity is pretty interesting. Everyone wants to live long. We all want to live long. And if God blesses us to, with such a long life, it gets to a point where that longevity is not just a problem to yourself, but also a problem to those around you. When you start becoming a burden to other people around you, when you actually still want to live but don't want to be a burden. So what are the solutions that we are able to present with this profession that we do, and more so with FEG or Freedom Equity Group? So with death, now we look at insurance. And for those of you that are not tracking well in English here, that's where we come up with this life insurance, as it's written in that Kinyarwanda there. And then for sickness, we have income protection. Income protection. Because remember, now you're sick, you're not able to go to work. You have to protect your income so that way you're able to keep earning. And then with the retirement, we have to plan that retirement where you are retiring with dignity and not even feeling down on the side of being a burden to other people. So how do we address all of this in one product? As a matter of fact, there are many products out there on the market. And this is where we transition now to a second piece that I wanted to talk to you. Sorry, I just rubbed that board there for a new write-up here. The first piece was death, which is when you die too soon. The second piece was sickness. And the third piece was, of course, living too long, right? Now, how does our product address these questions, these challenges, these threats to life? And we have to position ourselves in a sense that if someone is basically, first of all, effectively address the problem, because we have to make a case that everyone, regardless of who they are, whatever condition of life they're in, they are vulnerable to these things, all of these three. Death is just a matter of when, not if, much as all of these. So, first of all, we are going to look at what are the products out there on the market that dare to address these problems, and how do we address them ourselves here to take care of all of these three in one. So the first product that we talk about, and that we get even a chance to offer on this market, in this profession, is a term life insurance, because we're going to address all of this with life insurance. Now, life insurance has different types, and you will find lots of companies out on the market that are offering or claiming to offer to address these problems, but in which way? So you can address this with a term or different types of life insurances, but term can only go up to 30 years. Term comes in portions of years, 1, 2, 3, 5, 10. You could have a 1-year term, which is usually called annual renewable term, ART, or a 5-year term, or 20-year term. I think the max is usually around the 30-year mark. I've heard of, Corebridge can go 35, but usually doesn't go over that 30 range thing. And it's usually cheap to rent. We have to explain that to our people. It's cheap. You can, we've heard of, people who have group term at their workplaces, and they forget the idea that these group terms, they don't own them. They expire. They expire when they are laid off. They expire when they quit their jobs. They expire when they retire. And at that point, it becomes too late to buy or to go on your own. And then we have the whole life. Whole life is a different type of life insurance that can be used to address some of those problems. And as a matter of fact, we're going to look at how are these products positioned to address those three problems that we're looking up on top there. But whole life is built in this way. So you have this amount. If you're looking at my cursor, we have this amount that we pay monthly, and these are random numbers that I just chose for the purpose of this learning. Say you're taking on a product of $50 or $200. You're gonna have two things. You have this blue line and that green line. This blue line, let's say your promised death benefit of 200,000 or 200 million, could be M here or whichever amount you're buying in death benefit. But then we also get to have something called a CV, a cash value, which is in whole life supposed to be somewhere around 3 to 4%, earning in 3 to 4% of interest in fixed interest rate. So the portion of the premium that you're paying monthly splits into two. One is the death benefit of 200,000, and the other smaller portion becomes a cash value that grows into your policy. And that one gets interest. And that good? Great. And then the cost of insurance, which, increases as you grow older, of course, as in all types of insurances, especially those ones that are covering a longer span of life. But then this one we see, it is usually characterized by these three at least common features. There's a low rate of interest rate. 3 to 4 can be very low. given where the market is performing at nowadays. I think we're seeing somewhere around 6-7%. And the cash value here that we're talking about is usually not designed for you. That's what we say. Not designed for you in a sense that at least for quite some good few years, at least 5, 10, the first 5, 10 years, you really don't have much access of that. You can access some here, very small portions of that cash value that is in the policy. And very commonly, the living benefits in these kind of policies, the whole lives, those living benefits are usually not there, or if they are there, they're not as much as one would want to access them. Then the other piece, the third piece is a variable universal life. It's actually built in the exact same way as a whole life, just as you can see the way it was put up together there. The only difference is this curve here. Now, this is varying, as you can see, up, down, up, down. So the fact that there's a change here, even though they are built in the exact same way, but that this tiny difference makes a whole lot of dynamic that one would want to be careful about. The cash value was getting a fixed rate here, but in variable, as the name suggests, it varies. It varies based on the stock. It shows here based on the stock. So, people who are risk takers may just, find themselves, very passionate about this kind of life, this kind of policy. But the fact is, this insurance is also open to people. It's up to one to choose or not choose. If I'm, really pessimistic on risks, then I may want to think of something different, maybe whole life or something else that could be in the market. We got to see what else is there. But look at the interest rate there. It's, up somewhere around 4 or 6%. The market could even do incredibly great in one time as it goes up here, or even go low to the lowest of levels. And you swing with the market in this case. Remember, on whole life, you're fixed. If the stock goes way down, you're good. If the stock goes way up, then you're still in the same place where you were. So that's a very big difference here of swinging with the market. The characteristics here is this can be very risky, especially when the market goes all the way down. Now, with that said, it could even be great when the market goes way up. But who knows where the market goes? Market is supposed to be determined by the forces of demand and supply. So in this case, we don't really see much of piece in this side, on this side, and then we can settle on this. The third piece, which is the last one in this case, becomes the index universal life. So this is the IUL, and this is what you're gonna hear most talked about here at AFEG, and we're gonna see why. We're gonna see why is it such a huge deal with Freedom Equity Group. The way Index Universal Life is built is the exact same as those two above, 2 and 3. And if you can see here, the difference now has become what? The cash value goes even higher and is based on what? On index. I hope everyone here understands their, I'd like to think, but if not, then it's totally fine. The difference between a stock and an index. A stock is one company share. An index is a combination. Each index has a combination of thousands of stocks in one. It combines lots of stocks in one, whereby if one company was to be hit by whatever market trend, then many others are still holding stable or even going up. So this is, certain to provide more interest, as you can see there. At the time this was made, the cash value in IUL was earning somewhere above 8 or 7%. And these are no-brainer for someone who is at 3 to 4%. So the fact that it's tagged. The cash value, the interest earned in this life insurance, in the portion of your premium that earns you interest, is tagged on the market, and not just the market as it goes up and down, like in VUL, but the market on index, on indices. We have about 7 indices with Freedom Equity Group, as we'll see. So you get the death benefit, but also you get more cash growth there. And this one has actually another feature that we would like to talk about. You look at this kind of ladder steps going up. So the curve here is different. The curve in IUL, that's why we take it outside of this quotes here and put it on the side just so you can look at it. Instead of up, down, or straight down, as in IUL or VUL up, down. For IUL, the curve goes up, flat, up, flat. So the flat part is what we call the flow rate. You still get the rate of interest. You get a return you are able to earn even when the market goes flat, goes even further down, because the worst case that can happen in this case in IULs is the market going down and you have no loss at all. So you only keep the upward potential and you're protected from the downward risks of losing money. You can lose money in there. And this is mind-boggling for most people who are used to the market. The characteristics of this type of insurance is you get a higher return in here, higher rate of return. You get a cash value that is designed for you. We have such products like Freedom where you're able to access a good portion of your premium in the first year. Right from the first year, you're able to access it back in return as the cash that you're growing in your policy. You don't gonna have to wait for all those, 5, 10, 15 years to be able to access your money. It all depends on how your financial doctor, you, the financial doctors, some of you who are here, design it up. And then we have the living benefits, which we get to talk about. Now that we see the 4 products that are on the market, these are the 4 products that you mostly find on the market for people who are trying to address these 3 problems on top using a life insurance product. When someone says, hey, I'm in life insurance, hey, I'm trading this, I'm selling life insurance, we should be able to look at the ways how are those products, how is one positioned to take care or to help the customer take care of these 4, or rather these 3 threats to life. Now let's look at the first one again. The first one was a term. And if we're understanding these problems, how much do you think term is going to take a shot on addressing each of these? Well, since there's a death benefit alone here, term can only go to death. It can only cover death, as you can see. Because there's no, if say someone was to be get sick or whatever, not able to work for another 12, 6, 15, 24 months, term would deplete, will run out. And as a matter of fact, you can't use term to plan for life when you live long, unless you're taking your term when you're late in life, maybe say 40, and assume to die at some day because you're not going to grow cash in there. So that means in your advanced age, you're not going to have any money in this policy to help you on your growing bills. Remember, the bills are not really tagged to age as much. They still have to keep going. Uh, let's look at whole life. Whole life would give a shot at, yes, for sure, death, which is, sorry, my language here about dying too soon. Death is death. Whenever you die is, that's death. But it gets more worse when you die too soon, unexpectedly, abruptly. But at least in this case, you have a death benefit that you can lean on, that your dependents can lean on. But if you were to get sick for quite some time, the cash, the amount of cash that you're growing in this cash value will not be substantial enough to help you take care of these other pieces. Why? First of all, the portion of premium that goes into growing the cash is not as much. It's very limited. As a matter of fact, it's controlled by the insurance carrier. It's not determined by the customer. Two, the rate of return is very low. One is fixed, then it's also low. The market may be performing better, but you don't get to benefit as much from how the market is doing. So in this case, then we don't see any um, chances of taking a shot at disabilities or retirement times. The money would run out really quick and fast. The third portion would be variable universal life. There's a chance of the market being, positive and earning some interest out there, but then you can lose it overnight. You wake up one day, or maybe you start your day when things are great, and by the time the sun goes down, it's a completely different story. So in this case as well, we have the death benefit that we can lean on. So that way we say variable universal life is very fine on death benefit to address the point of life insurance on death, but the living benefits, which are used to address the sickness or the retirement benefits for living too long, are not in this. So this type of product cannot effectively address these three problems as well. So the last piece is IUL, which we just talked about here. Given the amount of, I mean, you can see this on actually very different levels. First of all, there's a death benefit, just like in any other of these three above. We have a death benefit. We have an increased interest that comes from these indices, the indexing strategy of only participating on the market when the market is trading positive. Once the market goes negative, then you go flat. You don't lose money. That's why I say, you know, you're earning even when the market is going down, because at least you're not even getting complete zeros here. Even if the market crashes below the zero line to a negative performance, you're still getting a positive interest. In the case of FEG, they provide 0.25%, which is the floor rate. Now, when there's a floor rate, you expect also a cap rate. We're not going to talk about the cap rates right here tonight, but those are all financial games that have to play out. So at least in this case, since it's the worst case scenario, it's a hedge against any risks and any downturns of the market. We have to keep in mind that there's a floor that we can't go below. Now, with that said, being able to access your cash, which is designed for you, we consider an example of a freedom policy with Fidelity Investment Guarantee, Fidelity and Guarantee Investment. They provide ways of accessing your cash as early as the first year. If you consider products like Freedom, I don't know if it's still there or it's been even been improved at this point, but it keeps getting better. And then so we have benefits, living benefits that are with living benefits at this point are with IUL, we cover there's a coverage of about three types of living benefits: terminal, chronic, and critical illnesses. And we get to see those ones later as we dive deeper. So how does the third one address the three? The first one is the death benefit for sure, the living benefits for the sicknesses, and the retirement part of it when one wants to live too long. Now, those are the four products that are there. We strongly here go on IUL and term products. We won't see much of number 2 and 3 in Freedom Equity Group, but yeah, that's where we are. We can look deeper. I had one more presentation now that goes deeper into IUL. How does this IUL, how is it structured? How is it built up? Then you get to understand more deeper of the different pieces of IUL in addressing all of these three threats to life. But let me hold off for now here. First check in. I hear there should be lots of questions coming up there which would enrich our talk. If time allows, then we can dive deeper into the number four there. Harriet, go ahead.
First question was, is the Freedom Equity Group the only company that offer IUL in the
The quick
market?
answer there is no. There's lots of, it's like a market. It's a market. We have a lot of companies that offer IULs.
Okay, that's good. And then the variable universal, did you say that it doesn't have a death benefit or just living benefit?
No, so just actually to tag that one to your first question, different companies have different definitions of living benefits. So variable, let's consider like say a company like Mass Mutual or New York Life or many other companies out there. If you go to those companies, some of them won't even be selling IULs, maybe selling a different product. And they say they have living benefits. But the way they define living benefits will be different. They'll say our living benefits is just, when you have a chronic disease, and that's it. And that chronic disease, they can only determine it if it goes only for 12 months. And another company would say, no, for us, we can take the chronic disease that goes up to 2, 3 years. I think usually the longest one would be somewhere around 24 months. So it's a call of the career of the insurance company itself. They say, okay, our living benefits covers this and this and this. So in the case of FEG and Fidelity, the living benefits usually goes up to 24 months, 2 years. But yeah, some companies would have living benefits, others not. Now, in these products, these two above that we see here, whole life and variable universal life, the living benefits in those products are very limited compared to IUL. All right, Harriet, all good there?
Yeah, thank you.
Awesome. Any other question? Maybe before I just show you one last piece here of the IUL side. All right, let's look at this. This is the IUL piece that would dissect all parts of an IUL. So IUL, as most people call it, or index universal life, the product has basically three pieces, three big parts. The part of living too long, that's the first piece, or maybe the third piece, depending on how you're counting, up, down, down, bottom up, or top down. If I start with longevity, because that's what I would wish you all to live long, how does the IUL address the portion of living too long? There are three ways or three tools that are used to address this piece. The first one, of course, is the indexing, the strategy of protecting your savings from loss and providing you the upside potential of the market. That's embedded in the name itself, as they say, index universal. So remember, this indexing has to do with dealing with those indices that are strong on the market, like S&P, if you can think of indices, the Dow. There are many indices there. FEG and Fidelity have great indices involving BlackRock, which is the greatest asset manager in the US, I think, or worldwide. We have I think of there should be about seven of those that you get to have access to in a single product. And then there's a rule of 72. This has to do with compounding your interest as you're growing your money. In that case, you make the interest work for you and not against you. So the rule of 72 can be a little deeper, but the quick piece of it is that it's all about determining the amount of time it's going to take for your money to double. You take whatever interest the rate they are giving you. If say they are giving you, maybe the company is giving you about 6%, you divide 6% by, rather you divide 72 by 6%, and then whatever number you get, that's the amount of time it's going to take for your money to double. So this is more about growing your money. And then the tax-free piece is all about maximizing your tax advantages to create way crazy more percentage of times of growing of a grown income. And on that price, say if you're paying maybe for an entire policy lifetime, you paid, say, 100,000 or 200,000 in premiums. And then by the time you cash out the death benefit and those, you know, cash that have grown in, you are 3, 4, 5,000% times more of what you're getting back. Now, the second piece of IUL would be the death piece. If one was to die, that one is straightforward. As a matter of fact, most people would have an old school perspective of life insurance where they think life insurance only in terms of this red piece. They think it's all about death. No, it's not. It's actually, the death piece of life insurance is, in this case of IUL, only, not even 40% of life insurance, not of what it means really to have a life insurance policy. So with IUL, you can use particularly life insurance to grow your money or plan your retirement. And then now comes at the same time as you're growing your money and planning your retirement, but you're also hedging against leaving nothing for your dependents. So at least now you have a legacy, for sure there's a legacy behind of tax-free money that you can leave for your dependents. And then the last piece, the third piece was the sickness part that we looked at as the life rate. Here we get when we say when you get sick. When you get sick, you get to get those living benefits. And in the case of Fidelity and Freedom Equity Group, this is how they define living benefits. The tax-free income from your life insurance face amount that you get when you become sick. And there are 3 types of illnesses they cover. Critical illnesses, and here they go down even as specific as addressing what kind of sicknesses in critical part. Heart attack, stroke, invasive cancer, organ transplants, all of these. Burns, end-stage renal failures. And these are very common plagues that are coming around people's life nowadays. But also have the terminal illnesses that can go up to 2 years or less when you still have that time to live, where the doctor says, oh, you have 6 months to live, depending on whatever diagnosis they're making. If it's a US physician and determines that you have less than 2 years, then you could well take that note, medical note, doctor note to insurance company as a prescription note, start cashing out your policy. And the last piece here was the chronic illnesses. The chronic illnesses is in a situation where you're not able to perform at least 2 of the 6 activities of daily living. And these are very common in this first world, in the advanced economies, where you find people still not able to do a whole lot of stuff they should otherwise be able to do themselves, and they end up getting into a heck of expenses to afford those services. So this is it for the IUL tonight. Maybe we can take from here. We can next time we will dive deeper into how do we structure those IULs. If the IULs is very well structured and very well funded, there's no better product out there for that. All right, I'll go ahead and stop it here and try to get as much questions from you or reaction, any comments, any add-ons or takeaways or what. Open up your mic, please, whenever you get a chance.
Hello, thank you so much, Mr. Herbert. That was a lot to learn for sure. One thing that I just wanted to clarify, and maybe you can correct me if I'm wrong, is the difference between index and like linking to the stock market. So when you invest in the stock market, you buy shares of a company, and your money is in those shares. If the company ever goes bankrupt or loses money or grows, then your money increases the same. But with IUL and some of these policies that are linked to an index, they're just mimicking the growth of that index and crediting you that interest. So think of it like a moving car. You know, if there's no car, there's no traffic, your car can move quickly, and that's the interest that you gain if the index is doing good. If there's traffic, your car will slow down, and that's when the market is not doing very good. If the market is doing terribly, that means there's heavy traffic, it's rush hour, your car might be stopped, but it won't go in reverse. It will just be at zero. But that doesn't mean that your money is actually in you have shares or anything. It's just imagine it as like a bank that is holding some of your cash value, and at the end of the year, when the market has done good, it credits you interest based on how the market did that year. And then the next year comes and it does the same thing. Next year comes and does the same thing with the cap. So if the cap is at 10% and the market does 20%, you get a cap of 10. If the market does minus 20%, it doesn't credit you anything because the S&P 500, for example, index didn't do good this year. So you get nothing. But they don't take away from what they already gave you in the past. It just kind of stays at zero. So that's how I kind of, so if it helps anybody understand the index linking better, those are the few analogies I would think of.
Awesome. Yeah. Yeah. I mean, I can't add any better than that. Thank you so much for that add-on, Collins. We just have about 5 more minutes to top of the hour. Any other comments?
Just a comment. This is Roy. How about you?
Yes, sir.
Done a very great job, and it goes ahead to emphasize, especially through the rule of 72, how these banks have all these flashy buildings and everything because they understand it better. So our job here is to let the people out there know how they can captivate and capture more of the knowledge to know where to go for a better interest. Thank you again.
Yes, sir. Yes, sir. Appreciate it. Yeah, that's a very good one.
Yeah, I think I can say a few words on that as well. So, as the topic of the tonight was saying, building financial resilience, and protecting against life's unexpected, events. We all go through those events, like Herbert well illustrated that. Unfortunately, most of our communities or most of our family members tend to think that that is something far away from them. So, but we see that happening all the time. We see our neighbors getting sick. We see our neighbors actually pass. So why don't we see so many people grabbing these products really fast? You would think that knowing how people do suffer out here, mostly in these developed countries, like mostly here in the US where we are, whereby you have a family, in this is you and your family. If something happens to you and you're the breadwinner, that family is not going to feed again. If you're paying your mortgage and you're the one taking care of your family, if you get a critical, a terminal, or a chronic illness, the check is gone down with you. So that is actually what we mean when we talk about those kind of financial some products we can have in place to make sure that whenever something happens, because again, as Herbert said, it's a matter of when, because all of us really, we're going to go at one point. Most of us are going to be sick. We don't need anybody to be sick. We don't wish anyone to be sick. But it's the same way we buy our car insurances. It's the same way we buy our home insurances, because we don't want anything to ever happen and we say, I wish I did this. So it is the same thing. For us, we have to make sure that really our families are protected. Those unknown events, whenever they come, let them come when we are set, because we cover everything else. We protect everything else. Why not the source of life? Why not the source of everything? You, the breadwinner, you, the head of the household, you actually yourself, who takes care of yourself by, taking care of you. Even if you're single, you still have a life to live. When you get sick, who is going to be there to take care of you? If you pass, do you really need a GoFundMe out there to take care of you when you're not there? So this is actually what we talk about, protecting yourself, protecting your family. And these great products are there for us to take advantage of. They're not as expensive as people may think, because most of the car insurances might even be more expensive than an individual taking a life insurance product, depending on when you take it again. As we all know, the younger you actually decide to take these products, the more profitable or the more cheaper it gets. And the beauty of that, you get to actually rock in everything. If you get a policy with an IUL or a term at age 25 or 30, you're going to be paying the same premiums until you are 100 years old, because like Index Universal Life, you covered up to 120 years. So the purpose of this training we always have on Thursday evening, that we call Financial Literacy and Money Matters, we are trying to educate ourselves, our communities, to be financially aware that these things do happen, but we need to be protected. Thank you so much once again, Herbert. That was a brilliant presentation that we all really have to think about and put it in practice as we go. Thank you.
Yes, Immaculate, appreciate that. And that's really very capping of this talk. And actually, we still have a chance for any other 2, 3 people before we cut it off here. Can we hear a little bit more about what we just shared, or anyone else's comment from those we haven't heard from? Any other person, please, before we take it off? Turatsinze, go ahead, yes.
Good morning. I think I just joined. I had left. I just joined. So what I would say is just good morning, and then I'll be following.
Awesome, awesome. We're actually wrapping it up here, but we have the record. If you just joined in here, yeah, you'll certainly be able to get the record maybe tomorrow on the platform if you're on the bigger platform with us.
Okay, thank you so much.
Pleasure, pleasure. Yes. One last call, then we'll just call it a night.
Thank you, Mr. Herbert, for the talk. Mine is a brief one. So you were discussing quite a bit about the different opportunities and how people can come in either when they live too long, when they get a chronic, terminal, unexpected illness. And then it's really about building financial resilience. So how do we encourage people who feel like that's too far to think about, like especially the young people? How do we emphasize that this is just as important, and there's also unexpected events that go on despite your age?
Great. That's a very great question, actually, Sharon. And it's very, very likely in the Gen Z, millennial, age groups. And interestingly, those are the very, very groups that should that have actually a better shot at this. Because personally, I wish I was. I know, of course, I'm still a Gen Z, but if I wish I was way back in my 18s, my teenage. The best way to talk to these groups is to be very practical, actually, and come up with the numbers. Because I realized tonight we didn't go into the throwing of numbers, because they're more about investments and the aspect of this IUL that would really resonate with their passions, with their aspirations, would be things of compounding interest would be things of a growing cash, because they're more on investment than risks, threats of life. Remember, these are groups that are not, these are folks that are not even, yes, affluent yet in any profession, but also they are, so the idea that they are young should actually give them a better shot, because we need to be illustrative on those numbers and show them how much less they can lock in for the rest of their life. And we have to illustrate the risks. I mean, everything has its pros and cons. So they have more pros than cons on boarding on this. Because if I'm going to jump on this myself, I'm being charged, 2, 3, 4 times more the amount than an average 20, health 20-year, 5-year-old would have to pay. So if we can get them down on the numbers and then show them practically the idea of growing money and the benefits of investments, how to invest and avoid taxes, and show them actually ratios on one, looking at life insurance versus the stock, investing in IUL, investing in a product that protects their lives, and talk more on the benefits part of it, because most of them take it for granted and they just have this kind of one blanket understanding of life insurance as something to cover your life. Yes, it does cover your life, but also sets it up on a better trend. And then also we also have to talk about the chances of creating a legacy when they start stepping into those responsibilities. Because most of them, you'll find they keep delaying, taking on bigger responsibilities of owning homes and starting their families and, taking care of their relatives and being able to stand firm and be the source of, funds or life into their line of families. That's, I think, one. And two is to talk their language. I think we should be able to take this. Language matters, communication matters. Once we come up with these ideas of life insurance, even not just the young ones, the old ones also tend to shy away from it and try to run away from it, because some of them have negative experiences. They've heard of different crazy stories coming, scam programs going on. So if we can switch it around and bring it in the language they talk, in the language that they understand, and address stuffs of investment and look into the money growth part and talk about what Collins just mentioned about of being in the market when actually not actually investing or taking the risks of the market. So I think that's part of it. Maybe our Royal Immaculate can talk more to that, but yeah, for the most part, that's what I have to consider. Anything you think that should be considered for the young ones?
I think you have actually exhausted that. That is it. To Sharon's question, Lily, it's never too early to get sick or even to die. So the young people, like you said beautifully, they feel like they still have time, but time to where? None of us has a particular time you're going to leave, a particular time you're going to be sick, or even taking care of yourself, like we're discussing. So the earlier you start, the better. That is it's never too early to start. Actually, the better you start. The earliest is today, actually, if I might say, because sometimes people think that having a life insurance is something you can have anytime. It's not actually like that, because you have to qualify for that. You have to be able to qualify to be able to get life insurance. So it's not actually a given. You might wake up and someone is sick and you're not able to get it. So the earlier you get it when you're still healthy and young, to be able to benefit from the cheaper or the less premium, and being able to save more because you have a big time. Like if you're 20, if you can put in some premiums until you're 65, you have actually saved yourself quite a big chunk of retirement money and actually money for your family. I believe, Herbert, you did perfectly good on that one.
So yeah, if I can show just a very quick one, not to go back into the presentation part, but for Sharon's question, if Sharon, if you can look at this screen here. So if you look at this, to what was, say consider someone was planning on building a 1 million retirement account by the age of 67, starting from $0. A 40-year-old and a 20-year-old, look at that difference. So one would need 319 at age 20. If they were to wait until they are 30, that amount has doubled. And if they were to wait until another 10 years, it has not just doubled, quadrupled, actually more than 4, if I can say. Here we're assuming at an interest rate of 6%. And remember, sometimes it goes even worse. The market goes crazy and the interest is not even 6. So these are the languages they need to look at because they consider themselves to be really savvy on these things. If you can get them to kind of do those projections, for those that can think long, see far, they may you tend to kind of get their aha moments and now give it another second shot.
Oh, how about you pay these premiums monthly until you're age 67?
Right. So
and then after that, if you're still alive, then there's no more premiums. You just kind of start enjoying your
there you go. So
your cash value. You start collecting on your cash value. I guess you can start at any point, but at age 67, what's unlocked?
There you go. So with that age, I mean, if one wasn't really mindful to start early on, you'd find maybe age 67, you have just put in about what, 4, 5, 10 years of premium, and you still have another pretty much a lifetime to keep paying those premiums even when you're not working. And that's the worst days. Those are the very worst days one would want to have when they still have to add those bills on when actually money is dried up. All right. I'd like to call it off now. Any pressing comment? We just pass it back to our leader, Margaret, to close it off, just as she started it on. Margaret, take it on, please.
Yeah, thank you so much, Herbert. That was actually very brilliant because every time we come here, this is why, because we have questions. People have questions. So it's not just us who are training, and even us who are training, we all learn together. Nobody will ever tell you that I have everything or I know everything, but we come here every Thursday with a different topic to learn together, to explore different, policies or just products we can use together to be able to help ourselves and help our families. So we always take lessons as we go. We take those lessons to heart. We make sure that although some people are yet to understand everything, at least some people are committing to building those strong financial futures. It is a process, it is a journey, but we all see, at least we can see from the presentation of how important of starting early. It's always easier or it's always better to start early. You don't have to be 20. Even when you're 40, you're better off than a 50-year-old or a 60-year-old because at 40 you still have a chance, but the older you get, it becomes more actually hard. So let's take those lessons. Let's keep learning. Let's keep educating our people. It is a crusade that we own as financial professionals and the Freedom Equity Group to take mostly those living benefits to our families and the communities. So let us all come together, keep learning, stay in the know, and be able to transfer those good products to our people. Thank you so much once again. Thank you so much, Mr. Herbert. This was a brilliant presentation. and the recordings will be up by tomorrow. So for those who came a little late, we can share, so you can go back and listen to everything. And to those who missed out, again, we want people to be able to have an opportunity to listen to what was discussed tonight. That is why we always record everything we do. Thank you so much once again. I'll see you all again next Thursday, same time. Have a good night.